Good morning, all of you. We can just start the sessions now. Up to now, we studied several aspects of investments and the different portfolio setups. And at the same time, we went through the different market conditions where we deal with capital market instruments like shares and other bonds, but we focused our attention to the return and risk characteristics of those things. And we started with the returns and the risk. So in that situation, we went through the risk return characteristics of different types of assets, especially the risky assets and risk-free assets. This is the basic demarcation in the investment arena, where we have to deal with either risky assets or risk-free assets. And the explanation with regard to the risk-free assets, we had a good discussion on that. I told you, normally the risk-free assets are government securities, basically. But even though we call them risk-free assets, there can be different types of risk other than the credit risk in that such instruments. But in a virtual situation, what we do is we just assume a 1 month treasury bill as a risk-free instrument, because even if market risk arises, it is in a minimal form in a 1 month treasury bill. Therefore, we normally assume the 1 month treasury bill rate as the risk-free rate. That is a convention. But the issue is, you don't find in Sri Lanka 1 month treasury bills. We have 91 days, 91 days, 182 days and 364 days treasury bills. And normally we categorize them as 3 months, 6 months and 1 year, whereas the days are in numbers. The issue is how we arrive at a 1 month treasury bill rate. So we have a way of doing it. We need to go through the yield curve. I told you what is the meaning of yield curve. Yield curve is a particular curve where we construct getting the tenor of the instrument into the x-axis and the yield of the instrument to the y-axis. So in that manner, we go by the 3 months, 6 months, 1 year, and more than 1 year type of instruments. And we do a plot. And with that plot, we get a curve. That curve is known as the yield curve. Even though we don't have instruments with 1 month tenor treasury bills, what we can do is we can extrapolate the yield curve to the y-axis, where we can arrive at 1 month treasury bill rate. Those things we already discussed. I want to just give you the meaning of risk-free rate. Risk-free rate is nothing other than the 1 month treasury bill rate. Now, why we are talking about risk-free rate? Because we need to deal with risk-free assets. And you can remember we did a certain Markowitz theory explanation with regard to the portfolios. And we took portfolios and we did some quantification into those portfolios. And all those portfolios are identified through their risk return characteristics. Now, what do you mean by that? Any portfolio can be identified through its risk and the return. So the risk return we calculated, and we got the different methodologies to calculate the risk and return. Now we have gone through such situations, and you know that any portfolio, the simplest portfolio would have two assets. That is the simplest form of a portfolio. Then you might have assets numbering 10, 15, 100, or even 1,000 in a portfolio. Whatever the number of assets you have, if you know the individual assets risk and return, you will be in a position to calculate the return of the portfolio and risk of the portfolio. All the methodologies we discussed. Now, with that, we found we can have different portfolios with different risk and return characteristics, and we can take those portfolios as the universe, and we can plot all those points representing the portfolios. So in that representation, what we did was we had a graph. That graph was constructed having the x-axis as the risk or sigma, the volatility or standard deviation, the y-axis as the return. If you do that and you plot the portfolio level risk and return being taken as coordinates, and we plot those things on the graph. And on that plot, we found there's a particular boundary, upper boundary of these points, and we call it efficient frontier. We call it efficient frontier. Now, why do you call it efficient frontier? Because if you find any point on that curve, so that particular point represents a portfolio, and in that portfolio you have a particular risk and return. So if you take that particular point into consideration, and if you take any point which is right below that point, you will find that that point represents a portfolio which has a lower return than the above said portfolio, but it has the same risk. So therefore, you can argue that the particular point on the efficient frontier is the most efficient portfolio you can find on that basis. So therefore, we can just understand all the points lie on the efficient frontier are efficient portfolios. But all these efficient portfolios may not have the same risk and return, but it can be different risk and return according to the investor's appetite or investor's risk profile. The investor can choose one of that portfolio. Only thing is that portfolio should be an efficient portfolio. So that is the risk and return characteristics depend on the investor's choice. Right. Now that is about risky assets. The efficient frontier is a particular curve. We got all the efficient portfolios on that. Now at that particular graph, we considered all the portfolios with risky assets. Then we came to the concept of risk-free assets. And we tried to see when a risk-free asset or when a risk-free asset portfolio is mixed with the risky asset portfolio, what could happen? And we did that. Now, if we do that, what could happen is, rather than having just risky assets in a portfolio, we would create portfolios with risk-free assets. If you do such type of mix and have different portfolios and have the risk and return characteristics of those portfolios. And if you plot that, you will find the efficient frontier of such portfolios can be taken as a straight line. Can be taken as a straight line. That straight line is known as the capital market line. It's known as the capital market line. So that we understood. So that is coming under Markowitz theory. And at the same time, you have to be careful about the characteristics of the capital market line. Now, the capital market line touches the earlier said efficient frontier at a certain point. So that point is known as that point represents the market portfolio. And at the same time, the capital market line touches or intersects the y-axis at a certain point. That point is the risk-free rate. So I can show it to you on the board, the particular diagram or the graph, and you will get a meaning on that. And at the same time, we discuss about the capital market line, and that capital market line is divided into two portions by the market portfolio. And the portion which is left to the market portfolio, that point is called the lending portfolio, and the portion which goes to infinity and it is right to the market portfolio is called the leveraged portfolio. And you understood why you say a certain type of portfolios leveraged portfolio, the other portfolios are lending portfolios. Because in a lending portfolio, you will find all the assets being lent or invested. But in a leverage portfolio, you borrow assets and you invest those assets in the market. So such portfolios are called leverage portfolios. So that's what we discussed. Later on, we extended our studies to stocks. At the same time, we talked in terms of stock returns, covariance of those returns, and even the correlation coefficient of those returns. With regard to the stocks, that when you say stocks means the risky assets. Stocks, debentures, and all such type of things are coming under risky assets. Particularly the stocks are the risky assets we talk about. And we went into the calculation of a particular coefficient called beta. Now, beta is a coefficient which gives a certain indicator of a stock. That indicator shows the particular stock's relationship with the market. Or in other words, how the stock behaves with regard to the market or in relation to the market. That is what the beta can represent. And we had some relationships, or we had some mathematical relationships where we can calculate beta. Now I'm just giving you a review of what we have done already. And later on, we had another graph. Now that graph we constructed, getting the beta into the x-axis and return into the y-axis. If you do that, you get a straight line. And in that straight line, beta is plotted, or beta is represented in the x-axis, and expected return is represented in the y-axis. If you take different stocks with different betas, you will have a return, equilibrium return, and beta, certain beta. Beta against equilibrium return. So that graph is a straight line. So that straight line shows a very important type of a relationship that we call the capital asset pricing model. Capital asset pricing model. So it's a very, very important model we need to talk or we need to study. And that gives a good methodology to quantify the behaviors of stocks in a stock market. Right. So then I will show you today, and the particular line under the capital market model, capital asset pricing model, sorry, capital asset pricing model. So that particular line is called a security market line. Now you have to see what are the differences. Or in other words, you have to compare the capital market line and the security market line. In the security market line, you get a straight line. That straight line shows, or on the straight line you find the, for different betas, what is the equilibrium return for a stock? What is the equilibrium return for the stock? What do you mean by equilibrium return? Equilibrium return is a return where you expect when the market return is when the market return and the return of the stock has a particular relationship, then we call that return the equilibrium return. So I will show you how we can analyze that. And at the same time, I told you the equation of the capital asset pricing model. So in the capital asset pricing model, you have the expected return equal to risk-free rate plus ERM minus R, that is the risk premium, into beta. So that is the capital asset pricing model's equation. Now, as per that equation, equilibrium return is the return that particular stock generates when the market is in equilibrium. But there's a certain methodology or certain way of selecting stocks for investments. Now, that is an important task any investor has to undergo, because when stocks being given or being offered for investments, that investor has to consider whether it is suitable as an investment. So how do you do that? Now, if you invest in the share market, your main idea is to get a higher return with the minimum risk. That is the investor's normal idea. Risk-averse investors' normal idea is that. So how an investor selects a stock? That selection can be made on the basis of its return. On the basis of its return. Now, we can check a particular stock's return by going through the stock market data. The prices of the stock, the beta of the stock, and all sort of things. Or even if you know the price and the variation of the price of the stock, you will be in a position to get an idea. Get an idea of the return of the stock. And if you know the beta of that stock, then we are in a position to calculate the equilibrium return. Equilibrium return. And if we find that the return of the stock is higher than the equilibrium return, then that should be you can invest in that stock because you are getting a higher return than the equilibrium return. And how do you find such stocks to be invested? The reason behind that is how do you select that? So the reason behind that is you will check whether it generates higher income, higher return than the equilibrium return. What are the stocks of that nature? So it is like this. If you have a stock and it is been undervalued means now you just look at the price and you have an idea why it is so low priced. But if you look at the company, you can see the company is doing well. But you can see, if you compare some other companies, there are some other companies which are less performing, but they have a higher price. So likewise, you can get some type of indication is low priced. The reason for that low price might be it is not in high demand. That may be a reason. But anyway, if you find such stock, undervalued stocks, there's a big potential for it to go up in price. So therefore, it would have a higher return. So undervalued stocks will have a higher return. Those undervalued stocks will generate a higher return than the equilibrium return. But overvalued stocks, what will happen? For an overvalued stock, there's a very little chance or very little potential of having a higher price because it has already been priced high. Such stocks are called overvalued stocks. Overvalued stocks, the investors should not invest because there's a very little chance of having a higher price for that. And the returns are low. Especially the return is lower than equilibrium return. So that is the conceptual things which we have already discussed. And today we will go into our lesson. In that lesson, we try to do some valuation of common stock. Right. I think last time also we discussed about this and we will continue with that. Now, this is what we are trying to do here is with the with analysis of the future cash flows, we try to arrive at the price of the stock. Now, under these concepts, we try to get the price of a stock. Now, the first thing is called a discounted cash flow approach, and we discussed some of it last time. Because these are dividend cash flows we are talking about, because the stock is taken as a perpetual investment where there's no maturity date, but you will get dividend cash flows for each year. That is our assumption. And we assume infinite number of years of lifetime for the stock. And D1 is the dividend income from that stock for the first year. For the second year, dividend income is D2. For the third year, D3. Likewise, it goes. And the last, we think that it is an infinite type of lifetime. So therefore, we take the last one as a infinite number, infinity. So that is infinite years dividend is d infinity divided by 1 plus k to the power infinity. So that's a, I mean, there's no meaning of this, but anyway, now it shows that the lifetime or lifetime of a stock is immeasurable, and we call it an infinite lifetime, and we most of the time we call it a perpetual security. Perpetual. It doesn't stop somewhere, but we call it a perpetual stock. And we have gone through that, and we calculated this we arrived at the one stage model for stock valuation in this manner. And there what we did was we just start with the current dividend, and we had an assumption where the dividends grow by a certain rate every year. That's a constant rate of increase. So that has been taken as G. So therefore, if current year dividend is D0, the second year dividend or the first year dividend would be D0 into 1 plus D. So that is the growth. It is a very simple phenomenon where, say, this time if you take the return of 10, the dividend of 10 per stock, and if the growth rate is, say, 25%, what will happen? In the next year, you will get 10 plus 25% of 10. 25% of 10 is 2.5. So the next year's dividend would be 10 plus 2.5. That is 12.5. So it is given in symbols. So you can just put it as D0 into 1 plus G. G is the growth rate. If you go for now that is the first year dividend, D1. D1 is equal to D0, 1 plus G. Then we can go for D2 also. D2 will be D1 into 1 plus G. I will show it on the board, how it goes. This, I don't know whether we have not, I think I have not explained it on the board. I will try to do it today. So anyway, this particular formula is a very important formula in this model. Therefore, it is very much important for us to do that. So I will just explain it on the board. Common stock valuation. Depending on getting the present value of future cash flows. Now, when you say future cash flows of a stock, what are the future cash flows? Dividends. Most of the time, there will be an annual dividend. Sometimes an interim dividends also paid. But we assume that annual dividend is paid. Now, what is now some other cash flows also will be there, but it's very, very rarely, because if the stock is sold, you get the proceeds, sales proceeds. So that will be another cash flow. Ultimately, that will be, you will have that cash flow. So if it is not being sold, you assume that you will have dividend cash flow for many number of years. Many in the sense, infinite number of years. And we assume the present year's dividend as D0. D0. Then the first year's dividend, then D1. D0 is the current year's dividend. D1 is the first year's dividend. Now we can see what is the connection between D0 and D1. D0, current year dividend. D1, first year dividend. In the normal circumstances, there's a growth in dividends. There's a growth. Growth in the sense, from year to year, it will be increased. And there will be a constant rate of growth. Now we assume that growth rate as G, simple G. G is the growth rate of dividends. Growth rate of dividends. Now we can write down D1 in terms of D0. Now D1 is equal to D0 into 1 plus G. G is the growth rate. D1 is equal to D0, 1 plus G. In the same manner, we can see D2 is equal to D1 into 1 plus G. Now, in the first equation, we can get the D1's value in this form, D0 into 1 plus G. What we do is, we replace D1 from this value. Then D2 is equal to D0, 1 plus G into 1 plus G. That is D0, 1 plus G squared. Now you can see a certain pattern now. D1 is equal to D0, 1 plus G. D2 is equal to D0, 1 plus G squared to the power 2. Then what is D3? D3 will be D0, 1 plus G to the power 3. Likewise, you can have D4, D5, D6, Dn or whatever, D infinity. Now you are not going to have any more type of unknowns. You have only D0 and the growth rate. With that, you will get any year's dividend calculated. If you want to calculate the 10th year dividend, what you can do is, you can see D0 into 1 plus G to the power 10. That is how it is being calculated. So with that, we try to get the total of present values of those dividends, assuming that we will have a lifetime of an infinite number of years for that particular stock. Then we have to go by the cash flows, present value of the cash flows. Now in that case, there should be a certain discounting rate. Now discounting rate is taken as the rate of return. Rate of return or return on capital, we call it. Required rate of return. So that required rate of return is assumed as K, or that is the discounting factor here. So therefore, if you have a D1 type of a dividend income in the first year, what is the present value of that? D1 divided by 1 plus K. If you have a dividend cash flow of D2 in the second year, what is the present value of that? D2 divided by 1 plus K to the power 2. Now, K is the discounting factor and it is the internal rate of return. Rate of return. Or required rate of return. We normally call it required rate of return. That is K. Now, you have to be familiar with these notations. Simple G is the growth rate of dividends. D0 is the current dividend. D1 is the first year dividend. D2 is the second year dividend. Likewise, you can have Dn is the nth year dividend. Then K, what is K? Simple K. Simple K is the required rate of return. Sometimes in some organizations, we call it the weighted average cost of capital. We will see in different problems, we have to go through such type of points where we can explain. Right. I think now this particular cash flow basis, you should understand. Then what we need to do is, we need to adapt all these cash flows and get the present values of those cash flows. So likewise, now you will get cash flows D1, because the current year's cash flow we are not bothered about. We bother only about the from the first year. Right. Now, if you take the cash flows as D1, D2, D3, D4, and up to Dn or D infinity, those are the cash flows. And if you want to get the present value of all these cash flows, you have to divide it by 1 plus K, 1 plus K to the power 2 likewise. Now, so you have to divide D1 by 1 plus K. Then plus D2 by 1 plus K to the power 2. Then D3 divide by 1 plus K to the power 3. D4 divide by 1 plus K to the power 4. Likewise, it goes. When you go into the end of it, that is Dn divide by 1 plus K to the power n, or D infinity divide by 1 plus K to the power infinity. So likewise, it goes. I have explained those things on the lesson. This is only a demonstration on the board, because I think if someone is unable to understand these things by looking at the lesson, they will get certain support from this. That's what I am doing this. So anyway, now then we get that summation. That summation we get. I will show you that summation on the board, and we need not put D1, D2, D3 and so on. What we can do is, we can put all those values in the form of D0 and G, 1 plus G. That form we can put. So the first one we can say as D0 into 1 plus G. Then the D2 is taken as D0 into 1 plus G to the power 2. Likewise it goes. So I will show that to you on the board. D1 is D0 into 1 plus G. divide by 1 plus k plus d0 into 1 plus d to the power 2.
So excuse me.
Yeah.
Can you write down in the middle of the board? It is
Okay.
impossible to see.
Okay. Now what I am going to do now is I will write on the board the summation of future cash flows for a stock. Summation. The first cash flow is D0 into 1 plus D. D0 into 1 plus D. We normally put it as D1. D1 is equal to D0 into 1 plus D. D0 is the current year's dividend. G is the growth rate. And this has to be present valued, so it has to be divided by 1 plus K. Now, K is the required rate of return. Required rate of return. Right. This is the first year's cash flow, and it is taken in a present value form, and it has to be divided by 1 plus K. The second year, D0 into 1 plus G to the power 2 divided by 1 plus K to the power 2. 1 plus K to the power 2. Then the third year, D0 into 1 plus G to the power 3 divided by 1 plus K to the power 3. Now it goes on. Next one would be D0 into 1 plus D to the power 4 divided by 1 plus K to the power 4. But we can put dots this way. And the last would be D0 into 1 plus D to the power N divided by 1 plus K to the power N. N is a number, any number. If one says it is 100,000, the other one can say it is 200,000. Likewise, there is no N for this. So we can say N tends to infinity. It can go up to infinity. So that is why we call it a perpetual stock. Perpetual. So this is equal to the current price of the stock. This is equal to the current price of the stock. Now we will see how we can simplify this. Now, this is a long series of terms. It's very long. So therefore, we try our best to put it into a very simple formula. Now look at it. You can see D0 is everywhere. It is a common term. D0 is a common term. So therefore, what we can do is we take D0 out from this. And not only that, 1 plus D divided by 1 plus K also, we can say it is a common term. It's a common term. Or anyway, it is better if you can do this. We can do this way. We can only take D0 out. Then you have a like this. 1 plus G, 1 plus K. Next thing is 1 plus D squared, 1 plus K squared. Then 1 plus G to the power 3, 1 plus K to the power 3. Then 1 plus D to the power N, 1 plus K to the power N. Right? And you can close the bracket. Right. Now look at the terms included within the brackets. Within the brackets. Now if you look at that, what is that? It's a summation of a geometric series. Summation of a geometric series. 1 plus d divided by 1 plus k. This is 1 plus d divided by 1 plus k square. This is 1 plus d divided by 1 plus k to the power 3. So why do I say that this is a geometric series? The summation of a geometric series. Because there's a common ratio. Can you tell me what is the common ratio for this? 1 plus d over 1 plus k is the common ratio. So I will put it somewhere here. This is a geometric series with common ratio. Can you see that? Common ratio 1 plus g over 1 plus k. This is the common ratio. This is the common ratio. And I don't know whether you have gone through this in your grade 10 or grade 11. The summation of a geometric series. Summation of a geometric series. And especially this geometric series is an infinite series. Infinite series. And not only that, there's a special characteristic of this series, so that we have to understand. Now I am just asking you, what is the 1 plus d over 1 plus k? Is it greater than 1 or greater than less than 1? That is what we need to ask. Now, in order to have a possible dividend growth, so dividend growth, we have taken dividend growth as g. It has to be lower than internal rate of return or the required rate of return. So you can't pay a dividend at a rate which is higher than your required rate of return. So therefore, there's a limitation here. That limitation is g should be lower than k. G is the dividend growth rate. K is the required rate of return. If the dividend growth rate is higher than the required rate of return, we can't follow this methodology because you will be nowhere with that. You are not in a position to calculate the summation of this because it is a infinite series. So you can't value this. In order to value this, there's a condition. That condition is dividend growth rate should be lower than the required rate of return. Now we can just put it in symbols. G is less than K. G is less than K. Now make sure that you have this idea in your mind, but there are peculiar situations where some companies, they declare dividends and the growth rate is very much higher than the required rate of return. If that is the case, we are not in a position to follow this methodology to arrive at the price of the stock. I think you got my point. So in order to use or apply this method to get the price of a stock, what is the condition? The growth rate of dividends should be lower than the required rate of return. So that's a very, very important point to note. I think you gathered what I said. Why do I say that? Because if G is greater than K, this particular ratio would become greater than 1. So since this is a infinite series, you will not be in a position to calculate the summation of that, because that will give you an infinite value. So it is meaningless. Therefore, in order to follow this methodology, there's a condition. The condition is G should be lower than K. G is the growth rate of dividends. K is the required rate of return. For example, say a company, their required rate of return, they have found that it is 15%. So the growth rate, can it be 20%? No. In normal circumstances, it is not. In normal circumstances, it should be either 10% or 11% or 8% or that type of a thing. So that is what you need to understand.
Excuse me.
Yeah.
Can it be equal to G? Yes, okay.
If it is equal, yeah. If it is equal, what will happen? If it is equal, yeah, then this will become 1. 1 plus G or 1 plus K will become 1, no? Then there's no, yeah. It's a situation where if it is equal, that is also no, there's no value for that. That is also infinite, if that is the case. If G equals K, that is also infinite.
Dividend, no?
Yeah.
Fixed dividend will be paid.
One?
It will be a fixed dividend. Fixed amount of dividend.
Fixed. No, if it is a fixed amount of dividend, G is 0. There's no growth, no. If the dividend is fixed, then what is the meaning of that? G is 0, no, in that case. G is 0 in that case. So those things actually we can't really, if there's no dividend and if it is a fixed dividend, then what happens? Then you can say every year you are getting this much of a dividend. And what we can do is we can get the present value of it. No issue, no? We can get the present value. But what happens is now, if G is 0, you get this as a total of it. That's all. Because now say you have a dividend of 10 rupees per share today, and the current one. Next year also you get 10. Next year, second year also you get 10. Then it's a matter of getting the present value. If you know the required rate of return, then you can just calculate it without having this type of series. But the matter comes when there's a dividend growth, constant growth of G, and that G is lower than K. When G is equal to K, what will happen is, what happens? Then there also you will get the infinite type of a thing. So that is also meaningless. Now, what I want to tell you is, if G is equal to K means the company growth rate of dividend is equal to their required rate of return. So that is also an infinite case. I will show you why do I say that with the next equation, right? For the time being, you need to understand that the condition to apply this formula is that G should be lower than K. If G equals K or G is higher than K, the methodology is not valid. But there's another way of tackling that. That's what I want to tell you. Because even though this is the normal way of organization, there are some organizations who declare dividends at a growth rate which is higher than the required rate of return. There are some organizations. Now that normally happens when a company starts their operations, a new company, innovative companies. They declare high level of dividends with high growth. They are, which is higher than their, very much higher than their required rate of return. But they do it for a limited number of years, say 2, 3, or 5 years, they do it. If that is the situation, we can't follow this particular methodology to get the value of the stock. That is what you need to understand. And there's another model called two-stage model. So that we have to apply that case. Right. Now, I will now discuss a situation where G is less than K. We have omitted the other situations where G is equal to K and G is higher than K. That can be discussed under two-stage dividend discount model. Two-stage model we can apply for that. Right, anyway, now I will show you how we can calculate this. And this is a type of geometric series. And in a geometric series, there's a formula for the summation. There's a formula for the summation. Right. Now, if you apply that summation notation or summation formula for a geometric series, so there you get this formula. A into 1 minus Rn divided by 1 minus Rn. A into 1 minus Rn divided by 1 minus R. R is the common ratio. Now, in this particular case, the common ratio is 1 plus G over 1 plus K. 1 plus G over 1 plus K. If you apply that and get it calculated, so I will show you the calculation. What is A here? Same thing. A is the same. 1 plus G over 1 plus K is A. And 1 minus 1 plus G 1 plus K to the power n. 1 minus 1 plus G 1 plus K. Now there are two ways of getting it. Now what I did was, I just used the summation of a geometric series formula. Sn is the summation of n terms of a geometric series, that is equal to A is the first term, into 1 minus R to the power n. R is the common ratio, divided by 1 minus R. So A is equal to 1 plus G divided by 1 plus K into 1 minus 1 plus G over 1 plus K to the power N. Now I just want to show you what is really happening here. Now I told you this is a perpetual type of a stock. What do you mean by perpetual? It has a lifetime of infinite number of years. That is the assumption. No one is infinitely living, but that's an assumption, right? So therefore, N goes to infinity. Now, when you look at this ratio, 1 plus G over 1 plus K, what do you say? 1 plus G over 1 plus K. G is lower than K, or G is less than K. Then 1 plus G over 1 plus K, what is the nature of that? It is less than 1. It is less than 1. Or in other words, it is a ratio. It is a ratio. Less than 1. Like, if you put it in terms like this, 1 over 3. This is less than 1. 1 over 5, 1 over 2. All are less than 1. Now, this is also a ratio of that form. Now, if you raise it to a higher power, what will happen? Now, I'm just giving you an example. Now, this is not really, really investment management, but this is mathematics here. But I think to just understand these things, you need to have some idea. That is why I'm just giving this. Now, say this is a value lower than 1. It's a fraction, no? Now, if you have this fraction and you do it, raise to a higher power, say to the power 10 or something like that, then you will see that you will get a very, very small number. Now, if you raise it to the power 10, what will happen? 1 over 3 to the power 10, what will happen? Yeah, 59,049. So then you get an answer if you put it to the power 10, that is 1 over 59,049. Right? So the meaning is, if you have a particular ratio which is lower than 1, if you raise it to a higher power, the value of that is very much small. Now you can look at this figure, 1 over 59,049. This is close to 0, is it? If this value goes very high, it can be 1 million, no, 10 million or whatever it is in the denominator, then that figure is a very, very small figure. It's a 0. So what you do is, since 1 plus G over 1 plus K is less than 1, its power N. Power N is a big number. So therefore, this particular ratio, 1 plus G over 1 plus K to the power N, will become 0. Then our formula will become this. Sn equals 1 plus G over 1 plus K, 1. This one will become 0. Then divided by 1 minus 1 plus G over 1 plus K. Now this will become the answer. Then we can just simplify that. I will simplify it here. Sn is equal to 1 plus G, 1 plus K. You get 1 plus K minus 1 plus G. Divide by 1 plus K. Now this is what you get. Then later on you get this 1 plus G 1 plus k. 1 plus k goes to the upper level, and you get here 1 and 1 cancelled, k minus g. K minus g. Yeah. K minus g. So then you can cancel off these things. D0 is also here, so we can put D0 is D0 also here. Then you get the figure Sn is equal to D0 into 1 plus g divided by k minus g. Right. Now this Sn is the stock value or stock price, P0 is equal to D0 1 plus g divided by k minus. Now this is what you call the one stage dividend model. One stage dividend discount model, we call it. Now here D0 is the current dividend, G is the dividend growth rate, K is the required rate of return. Now if you find these things confusing, don't think about it, right? Don't think about it, because I have given it for the benefit of people who want to have a insight into these calculations. Those people will get a certain benefit from this. Otherwise, if you don't if you are very much confused with these things, forget about it. No issue. No issue. It is enough for you to have this formula by heart. I think it is not a very difficult one. D0 1 plus g is on the top, and in the denominator you get k minus g. Or to be, we can simplify it to another further extent. Then it is P0 is equal to D1 divided by k minus g. That's all. There are only three numbers, three points there, three codes, three letters only. P0 is equal to D1 divided by k minus g. So that is what you call the one stage dividend discount model. One stage dividend discount model. Any questions? Any questions? Now, if you look at this, you will find when G is higher, to a certain extent, you get a higher price, but I think that really depends on the D0. And if this difference is low, you get a higher price. This difference is low, you get a higher price. What do you mean by that? Yes. If the growth rate of dividends is close to K, very close to K, what will happen to K minus G? It will become a minute figure, very small figure. Smaller this figure, higher the value of P. You understand that? Smaller this figure, the denominator, you get a higher value. Now I will show you that. Now say 50 divided by 5. Answer is 10. 50 divided by 2. Answer is 25. 50 divided by 1. Answer is 50. 50 divided by 0.5. Answer is 100. Now you see the point. If the value in the denominator is becoming very much lower, the value, actual value will go up. Here also it happens. Therefore, if you look at a certain stock and if you know the required rate of return of that company and see that their dividend growth rate is close to their required rate of return, close, not over, not higher than the required rate of return. If the dividend growth rate is very close to required rate of return, then you will have a very high price on the stock, very high price, because this particular figure becomes very small, very small. I think you got my point. Because these are the necessary type of analytical points. Then only you can discuss something and you can take decisions on these investments with that understanding only. Right. I think one person asked me if K is equal to G, what will happen? That is, he said that the required rate of return is equal to, right? You can just see here, what will happen? Equal to the growth rate. Now, what will happen to this? K minus G. It will become 0, is it? It will become 0. Now, if you divide something with 0, what will happen? What is the value? Infinity. So, it is a meaningless value. So, therefore, in order to apply this formula, we need to make sure that K is not equal to G. The required rate of return is not equal to growth rate. That is one thing. Or required rate of return is not lower than growth rate. Or the growth rate is not higher than the required rate of return. I think you got my point. If that is the case, there's another way of calculating the stock price. And we need to go for the two-stage dividend discount one. And if say if K is lower than G, what will happen? We can just look at it and see what are the types of values we expect for those situations. Now we put here to follow this formula, G should be less than K. G should be less than K to follow this formula. Now say there's a situation where K is lower than G. Then what will happen? What will happen? I think I don't know. I can't remember whether I discussed about this. You get a minus price, no? If it happens, you get a minus price. If K is less than G, K minus G will become a minus figure. It will become minus figure. When it becomes minus, P0 also will become minus. Can a price become minus? Can a price become minus? What do you mean by a minus price? I think I have discussed with you about this. What is the physical explanation of a minus price? Yeah. What is the physical explanation of a minus price?
Loss making?
Yeah.
Loss making? No profit?
No, not there's no loss at all, because now you are talking about the price. No, you are not going to talking about profit. Now, if you are talking about profit, the minus profit is a loss. That's correct. But what is the meaning of minus price? Price
Issued
is
at a discount price?
pardon?
Issued at a discounted price?
No, not discounted. Discounted means you reduce your price and give. Now, say for example, you have a mark price of 100 and you give at a discount. You say you give it at 50 rupees. That is a 50% discount. So minus means what?
Take good and money.
Pardon?
Take good and money.
Yeah. That's a good good explanation. I can. I think I have. I don't know whether I don't remember, because I discussed with you about this, I think. Anyway, now there's a particular, I can just remind of that. There was a advertisement about Kotroti or something. So what they do is, now they say, now they get uh, you get some money together with the goods. So that is what you mean by a minus price, because minus price means, now when you buy a certain thing, you give money, right? And if you want to buy a certain if you want to get something to your possession, together with that particular thing, you will get some money also. So that is the case. There you receive money when you get the goods. That is the opposite of that, no? Opposite of purchasing, no? So that type of a thing can be considered as a physical explanation of a minus price. So you get the goods as well as money. That is what you mean by that. I think in Asian countries, you have this dowry system. That is also a system of a minus price. You get the bride as well as money as a dowry. So that is also a explanation of a minus price. Anyway, it won't really make sense, because the notion of a minus price won't make sense. Therefore, what we can do is we can omit the other situations, and we are not going to follow this formula on those occasions, right? Anyway, now these things are very, very interesting, because you need to think over these things. And in analysis also, it is very much important for you to have an insight into these things. That is why I just discuss these things on the board. Otherwise, I could have just read through the note. But I think that it won't help. That is why, for the benefit of the people who need to have a good insight into the subject, I do this. And I really request you, if you have any confusion or any clarification, you have to just ask. Don't worry to ask questions. So you can argue with me, no issue. So then you can learn several things. That is what you need to understand. And if you just, as a machine or whatever, if you do these things, there's no, there's no advantage of that. It is a useless type of a thing if you do that. Because working out sums is not the knowledge. It is a mechanical thing. If you do it mechanically, I don't really value it. Okay. I think now you got some idea about it. And see, if an organization declares a dividend and it grows at a very high rate, normally it is been done by innovative new companies, startups we call them, to attract the shareholders. For such companies, the share prices being valued or share prices being estimated by going through a different methodology. It is not the one-stage dividend discount model. We should go for the two-stage model. Two-stage model. We will discuss on that later. Right. Right. Now we will go to the lesson and see how we can work out examples. During the session, if you have any issue or if you have any clarification, let me know. Then we can discuss those things. Yeah. Now all these things being discussed here, given on the note. Now, in order to just give a very good insight to the people who are interested in these things, I just did it in the board. It on the board. Now, here I have given all these things here. And I think this one we worked out last time also. Right now, today we are going to just start with the stocks with substantial annual growth of dividends. That's what startup companies normally with innovative strategies tend to pay above average values of dividends. This will result in substantially higher annual growth during the initial period of operations of the company. Now, that normally happens in the initial period. However, this trend gradually comes to a lower level after several years of initial operations. Now, that normally, say, from 5 years to 7, 8 years, it happens normally. But later, again, their dividend growth's been come to a lower level. And that prevail for a longer time. At the beginning, the dividend growth rate G may have a higher value than the required rate of return. But you can't apply one stage model for that. But this is not a realistic answer and one, yeah, that's what we already discussed now, these things. Right, now this is the methodology to calculate stock valuation or stock price when the growth rate of dividends is higher than the required rate of return. Right, now you can see the formula, but I just want to tell you the formula. Really, you should not by heart the formula, but you need to have some idea about it. Need to have some idea about it. Now just look at it. Now there's a notation here, summation we call it. Now this particular symbol is the capital sigma. You went through sigma earlier. Now we denoted standard deviation by sigma. No? But this is also we call sigma, but it is not the simple sigma. This is capital sigma. It really denotes the summation. Summation of this. Now from t equals 1 to n. So that means we can expand this d0 into 1 plus g, g1 to the power 1 divided by 1 plus k to the power 1 plus d0 into 1 plus g to the power 2 divided by 1 plus k to the power 2. d0 into 1 plus g to the g1 to the power 3 divided by 1 plus k to the power 3. Now if n equals 3, it prevails that way. Then you get dn, that is the nth year dividend, into 1 plus g2 divided by k minus g2 into 1 plus k to the power n. Right. I will just explain how this particular formula has derived. Now this particular formula we normally use for a dividend growth which is higher than required rate of return. For such type of stock, we need to apply this formula. We can't apply the earlier one, the one stage model, because when we apply that, you will end up with meaningless results. So therefore, we can't go for a solution with that. Therefore, we have to use this particular formula to have a particular results on your stock value. Now here at the this particular notations being given here, DN stands for dividends per share in time period N. DN, right? G1 denotes the initial dividend growth rate. This is the initial stage dividend growth, and that's a very high rate. G2 represents the longer run dividend growth rate. Longer run in the sense, now, as I told you, the startup companies at the beginning, they have very high dividend growths for a period of say 5 to 6 or 10, 8 years. And afterwards, they become a normal type of a, they will pay only a normal dividend at a lower growth. So that is the normal happening for a startup. So then in this particular formula, G1 is the earlier stage dividend growth. So that's a high growth. And G2 is the dividend growth after a couple of years' time. Right now, example is also given here. The Saturn Computer Corporation has been experiencing an above normal dividend growth rate of 20%. This one we did, no, right, we have not done it. The Saturn Computer Corporation has been experiencing an above normal dividend growth rate of 20% per annum for the last 5 years. This above normal growth rate is expected to continue for another 5 years before it levels off at a more normal 6%. Saturn's last dividend was 50 per share, cents 50. In dollars, it is 50 cents per share. Determine the current value of Saturn stock if its required rate of return is 15%. Right. Now, we have to see what these data points are, and we have to just jot down the available data here in order to apply the formula. But what I feel is, rather than applying the formula, what we can do is we can just look at it in the point of view of a cash flow summation and getting the future cash flows present values. So if you put it in that manner, you don't need to buy hard this. Now, for example, what happens is, now for 5 years, what will happen? The growth rate of dividends would be higher, very much higher than the K. So therefore, we need to calculate the first 5 years cash flows in order to get that value. So therefore, we can say P0 is equal to D0 into 1 plus G1. What is that? G1 is what here? G1 is 20%. So 1 plus G1. What is D0? That is 0.5. 0.5 into 1 plus G1 is 1.2 divided by 1 plus K. K is how much? 15%. Required rate of return 15. 1.15. Then you add D0 into 1.2 to the power 2 divided by 1.15 to the power 2. Likewise, you should go up to 5. Then you get to the 5th year or the 6th year. Now, what is the 6th year dividend? You have to get the 5th year dividend into no, this is the 5th year dividend actually. Fifth year dividend, yes, 5th year dividend. We can calculate that. What is the 5th year dividend? D0 into 1 plus D1 to the power 5. That's the 5th year dividend. And it has to be multiplied with next year's dividend growth. That would be G2 divided by K minus G. I will show it on the board, right? I think you may not be in a position to. If you merely apply the formula, you can arrive at the answer. Here, the answer is given here. Here. Now I started with this. This is the first year cash flow, second year cash flow, third year cash flow, fourth year cash flow, and 5th year cash flow. On the 5th year, we assume that the stock is sold on the 5th year. Now, if it is sold, there should be a price, no? That price is calculated here. How do you calculate that price? There you can go to the one-stage model, because in that year onwards, what will happen? On the 5th year, or in other words, for the next year, the dividend growth has come down. So you can make use of the one-stage dividend model to calculate the price of it. So that calculation, now we have to get the 5th year dividend into 1 plus G. The 5th year dividend is given here as 0.50 into 1.2 to the power 5. And that has to be multiplied with 1.06. Now that is the formula. And divided by G minus K into 1.15 to the power 5. That is the present value. To convert that price into the present value, you divide it by 1.15 to the power 5. That's what they are done. Right. Now, after simplifying that, you will arrive at the value 10, 14. 10, 14. Anyway, any problem here? This is a situation where the growth rate is higher than the required rate of return. So you are not in a position to apply the one-stage dividend model. That is the issue. Anyway, we will do a small example before this, right? So then we can come to that. Right. Shall we go to the question number 6? Now, before going into that two-stage model, we will see some problems where we have to deal with some additional type of points coming into the problem. The ABC Corporation's dividends per share have grown at a rate of 6% per year for the past few years. That is the dividend growth rate, that is 6%. If this rate continues in the future, determine the value of ABC stock. Assume ABC's current dividend per share is 350, risk-free rate 9%, market return 16%, and beta of ABC is 1.3. Right. Now, anyway, now how are we going to deal with this question? Now, in order to calculate the stock price using the one-stage dividend model, what do you need? You need current year's dividend, you need dividend growth rate, you need. What else you need? Required rate of return you need. Right? But in this particular sum, the required rate of return is not given. But some data points were given in order to calculate the required rate of return. Can you see that? Can you see that? Because the beta is given, market return is given, so risk-free rate is given. By that, you will be in a position to calculate the equilibrium rate return. That is the required rate of return. Right. Now, I will ask you to work out the problem number 6. The first thing what you need to do is, you need to get the ABC company's rate of return or the equilibrium rate of return by using the capital asset pricing model. The data is available for you. Just do it. I will read the question for you. The ABC Corporation's dividends per share have grown at a rate of 6% per year for the past few years. If this rate continues in the future, determine the value of ABC stock. So that is the question, right? But in order to determine the value of the stock, you have to apply the one-stage dividend discount model. There you need, in order to get the value of the stock, you need present or current dividends. Then dividend growth, it is available. Current dividend is also available. We need the required rate of return also. But required rate of return is not given straightforwardly. But we need to calculate that required rate of return. But there's adequate data to calculate required rate of return. It is available using capital asset pricing model. So first thing what you need to do is, you need to calculate the required rate of return or equilibrium return of the stock by using the data available in the question. Just do it. Just calculate the required rate of return of this stock. Risk-free rate given, market return given. Now, first of all, you calculate the ABC's required rate of return or the equilibrium return by using the capital asset pricing model. Now, capital asset pricing model is required rate or the equilibrium return is equal to R plus, R is the risk-free rate, market return minus R into beta. That is what you call the market premium. Market premium into beta. you can just apply capital asset pricing model and come to the, you can estimate required rate of return or the equilibrium return for ABC stock. Laknath has given the answer. Good. Others also try and get an answer. Because I request all of you to engage in these things. Because that is the most important thing. Chamali, correct. Chamali also has got it. And you can just extend your things to the final answer. Because with that calculation, you have the required rate of return and other data is available and you can arrive at the stock price also. Just arrive at the stock price. Yes, Rohan, all those can just go into the question and work it out. Right, Laknath and Chamali has done it. The required rate of return calculated. Others also should come. Try others also try. And now after getting the required rate of return, now you have the growth rate of shares. Current dividend is also given. Current dividend is also given. Yes. Yes, Chamali and Laknath, you try to get the stock price. Now you have already, now this calculation is leading to K. K is equal to 18.1. G is given. And P0 is equal to D01 plus G divided by K minus G. D0 is known. G is known. K is also calculated. Then K minus G also can be calculated. Yes, come up with the answer. Yes. Now, after calculating the required rate of return, it's a very, you are very much close to the answer. Very much close to the answer. Yes, you can apply these things into the formula, that one stage model. There you 30.91. So just a small thing, you just try to hit it. Laknath, I have come to the, yeah, Madhubhashani's answer is correct, 30.66, correct. Laknath, you can just look at it again. Kamali, correct, answer correct. Right, I will do it for the benefit of the others. I will do it on the board. Now, I will just start from the beginning. Now, ABC Corporation's dividends per share have grown at a rate of 6% per annum for the past few years. If this rate continues in the future, determine the value of ABC stock. So that is the question. But later they say, assume ABC's current dividend per share is 350. Risk-free rate is 9%, market return is 16%, and beta is 1.3. So I will put the data on the board. Risk-free rate, that is R is equal to 6%. Sorry, R is equal to 9%. Market return, that is ERM, is equal to 16%, and beta is equal to 1.3. Now, by using the capital asset pricing model, we will be in a position to arrive at the equilibrium return. So, equilibrium return of ABC is equal to R plus ERM minus R into beta. So, R is 9%, ERM is 16%, R is 9%, 16 minus 9 is 7%. 7% into 1.3. This gives us the answer 9.1% plus 9%, that is 18.1. So this is the required rate of return for ABC, 18.1. I think this is very clear and very straightforward. No confusions here. Just apply the capital asset pricing model. So next thing is to calculate the share price. Now, in order to calculate the share price, now we will see. Now we calculated the required rate of return by using the capital asset pricing model. So you can say K is equal to 18.1%. Then what are the other given things? G. G is given, that is 6%. G is 6%. AG and D0 is also given. D0 is 350. Now I think it is possible for us to calculate the share price. Now share price is given by the one stage model is P0 is equal to D0 into 1 plus G divided by K minus G. This is the formula. So what is D0? 350 into 1 plus G is 1 plus 0.06, that is 1.06 divided by K minus G. K is 18.1%, G is 6%. 18.1 minus 6 is 12.1%. 12.1% is given in decimal form 0.121. So you get the answer 30.66. So that is how we arrived at the stock price. Now make sure that when you get a question, that question might test you not only one subject area. There can be several things which can be connected together. So therefore you need to have a clear idea about those things. And sometimes the stock returns might have been given. There can be a question whether you are going to invest on this stock or not. That type of things also can be asked. So you have to have some good idea about these things in order to answer these questions correctly. Now what I want to tell you is you should really understand the things, then apply the things in a correct manner. And always try to realize what you are doing. And there should be a sense for that. That if the sense is not there, I really feel that it's not worth doing these things. Now, you can see the benefit of this by having it in a very straightforward manner. Right, now we will go to our real session where we try to see the explanation on this two-stage model. Right. Now the two-stage model, even though the formula is given, it's not a big thing. So you can just consider it as a two-stage type of a thing. What are these two stages? One stage is calculating the present value of cash flows under the higher dividend growth. That is the first part of the calculation. Then the second part is to calculate the price at which it can be sold at the end of that period. At the end of that period, you would sell it. You would sell it, having the price. So that price can be realized after selling, and that will become a cash flow. So that is the second stage. That cash flow also has to be present valued. That's what we do. I will repeat it. Now, first thing what we do is, under the higher dividend growth, we calculate the couple of years cash flows and get the present value of that. The total has to be taken. Then we go to the end of the period and calculate the price at which the stock could be sold at the end of the period. And from that point onwards, the growth rate has come down. So we can use the one stage model to calculate the price at that point. And that is the realizable value. So you get that value and then it has to be present value. Then both has to be totaled up. And that will give the price of the stock. Now, what I feel is if you also try to do these things with me, that would be very much helpful. Right? Now, what you now should do is, you get this particular sum and just calculate the, now it will go for 5 years with the higher dividend growth. And for that 5 years, you calculate the cash flows. Now, I have given it on the lesson here, the way it is been done. Now, 20 is the growth rate, and 1.2, 1 plus 20, 4.2 is the expression we have to multiply with 0.5. Next one is 0.5 into 1.2 to the power 2. Likewise, it goes up to 5. And it is to be divided by 1.15, 1.15 to the power 2, 1.15 to the power 3. Likewise, it goes up to 1.15 to the power 5. And the next one would be, you get the price at that point, or the dividend at that point. That point dividend is 0.50 into 1.20 into 5. And it is to be multiplied with 1.06, because from that point onwards, the dividend growth has become 6%. And it has to be divided by d minus k, that is 1.15 minus 0.6. And it is to be present valued by dividing 1.15 to the power 5. So this is how the question is answered. Okay, now we will have a break and I will come back by 10:45. Till that time, you just go through this and see what are the types of confusions you got into your mind, and we can clarify that afterwards. Thank you. Two-stage dividend discount model. Now I will work out the sum. even in the supplementary problems. Sorry, not that. The example. The Saturn Computer Corporation has been experiencing an above normal dividend growth rate of 20%. Now, what we can do is we can just jot down the available data into the paper and we can start with that. So we can say D1 is equal to 20%. This above normal growth rate is expected to continue for another 5 years before it levels off at a more normal rate of 6%. So therefore, you can say G2 is 6%. Last dividend was 50 per share. That is D0. D0 is equal to 50 in dollars. The rate of return, required rate of return, that is K, is equal to 50. Now, in this question, the initial period is taken as 5 years. Within 5 years, the above normal growth will come to a normal growth at the end of 5 years. But they have said something about 5 years earlier stage also, but we are not going to take on that particular thing, but we start our things from the given place, and for that the measurement of time is 5 years. Right. Now with this, we will try to see the two-stage model. And why do we say it is two-stage? Because in the first stage, what we do is, during the high dividend growth period, we need to calculate the present value of those cash flows. Now we have to talk in terms of 5 years. In that 5 years, we receive some cash flows, and those cash flows we have to get the present value. So that is the first stage of this sum. Right, we will calculate that. So we can say for the 5 years period with for the 5-year period with higher dividend growth. Why do we say it is higher? Because at the beginning, the growth rate is 20%, which is higher than the required rate of return. It was 15. So the growth rate is higher than the required rate of return. So therefore, we are not in a position to work it out, work this sum out with the one-stage dividend model. So we should go for the two-stage model. That is why we started working out of this sum in this manner. Right. Now the first stage is to calculate the cash flows for the first 5 years. Right. The first one, first cash flow, that is the dividend D0 is 0.5 into 1 plus G1. That is G1 is 20%, 20% in decimal form is 0.2. Then 1 plus 0.2 is 1.2. Divided by 1 plus K. What is K? K is 15%. If you take 15% in a decimal form, we call it 0.15. So then the denominator will be 1.15, and this is the present value of year 1's dividend cash flow. Then you get the present value of year 2's dividend cash flow, that is 0.50 into 1.20 to the power 2 divided by 1.15 to the power 2. If you go for the third year, that is 0.50 1.20 into to the power 3 divided by 1.15 to the power 3. Then the next one is 0.50, 1.20 to the power 3 divided by 1.15 to the power 4. Next one would be 0.50, 1.20 to the power 5 divided by 1.15 to the power 5. Now these things, if you can calculate, that gives us the cash flows for the first 5 years, where the dividend growth is very high. Very high means it is higher than the required rate of return. Right. So that is the first stage. But this will not be sufficient for us to calculate the price of the stock. Now the price of the stock to be calculated with the other cash flow also. Now other cash flow is what? We think if it is sold at the end of the 5th year period, at what price it would be sold? Now we go into the end point where that is the 5-year period end. At that point, we look at the price it would be sold. So when you end up the 5-year period, the particular company goes to the stage of a situation where the dividend growth rate is not as high as earlier. It has come down to a lower level. So that is 6% in this particular case. It has come down to 6%. So therefore, we can use the one-stage model to calculate the price at the end of the 5-year period. Because at that time, the dividend growth is not 20%. It would become 6%. So there we can use the one-stage model. Right. Now we will calculate the price at that point. Right. So we can say, now this is the total cash flows during the high dividend growth period. Then we get total this present value of PV of total cash flows during the high dividend growth period. But then we need to get if the stock sold at the end of the high dividend period. The PV of sales proceeds now I think this is very much important. If the stock sold at the end of the high dividend period, the PV of sales proceeds. So the PV of sales proceeds means the selling price we have to calculate. Now, what is the formula for the calculation of the selling price? D0 into 1 plus D divided by K minus D. D0 is the present dividend. Now, what is the present dividend at the end of the 5th year period? That is D5. D5. D5 is D0 into 1 plus G to the power 5. So that is here you have it. Right, I will put the formula. Now as per the formula, right, as per the formula, the price is equal to D0 into 1 plus G divided by K minus G. But G here is G, not G1, is G2. That is why we can make use of the one-stage dividend model to calculate the price. Otherwise, we can't do that. Right? So then we will do that. Now, Dn or D5 is the D0 is at this point, and into 1 plus G1 divided by K minus G1. Sorry, G2. Here G2. So that is D5 is 0.50, 1.20 to the power 5. Divided by K minus G. K is 15%, so that 0.15 minus 0.06. Here, not 1.2, yeah, 1.2. And it has to be multiplied with 1.06. Not only that, what we need to do is, we need to get it to the present value. So then 1 plus K to the power 5 is also there. So then you can say 1.15 to the power 5. So this is the second part of it. Because how you see, this is the price calculation D5. Now at that point D0 is D5 into 1 plus D2 divided by K minus D2, and in order to get into the present value, it has to be divided by 1 plus K to the power 5. So I just put the values for that. D5 is 0.50 into 1.2 to the power 5. That comes here, and it is multiplied with 1 plus G2. G2 is 0.6%. Decimal form it is 0.06, then 1.06 divided by K minus D2, that is 0.15 minus 0.06 into 1.15 to the power 5. Right? So this is the calculation, and in order to get the price, you should add these things plus this, and you will arrive at the price. Any question on this? Yes, Laknath, Madhuvashini, Sanjeeva, all can have asked any question. It is okay, or it is understood. What I want to tell you is there's no need of by hearting the formula. By hearting formula would not be important, because if you have it this way, and it's a very burdenless type of a thing. Otherwise, what happens is, now if you try to by heart these things, then sometimes you might forget something, and you try to recollect it, and you would have a very big stressful situation when you want to recollect those things and in the examination time. Yes. Any questions on this? I think you all can work it out without much issue. Now all these things been worked out on the in the lesson, so therefore we need not again laboriously do the calculations, but I just want to show you the way it is been done. Any questions on this? Otherwise, we will go to you know, work out another sum. Right, now this calculation is given here also. And 0.522, 0.544, 0.568, 0.593, 0.619. Now that is the first 5 years cash flows, dividend cash flows, present values. And not only that, at the end of the 5th year, you assume that you realize that stock by selling, or you write this amount by selling it. Now when you sell it at that price at that time. That is D0 into 1 plus G divided by K minus G. But D0 at that time would be D5, not D0. 0.50 into 1.2 into 5. And it has to be 1 plus G. But G would be 6% rather than 20%. 1.06 divided by 0.15 minus 0.06. And in order to put it into the present value, it has to be divided by 1.15 to the power 5. And that comes to 7.29. And if you take all these things together and get the total comes to 10.14. The current value of the Saturn stock is 10 and cents $14. Right. Now we will try to just work out another sum even under supplementary problems. Now this time you try to do it. You try to work it out, because then only you get the real competent of doing it. Otherwise, what happens is, now if you just look at it and see and it is understood or whatever, but when you go to the examination or when you face with the problem, you may not be in a position to work it out. Therefore, you get that practice also, the familiarity also by doing this. Right, we will go to the question number 3. The Nilgala mining company has been experiencing rapid growth during the last 5 years. Analyst expects 30% growth rate in dividends to continue for the next 4 years. After the above normal growth period ends, dividends should grow at a more normal rate of 6% thereafter. Nilgala has a current dividend of 260 per share. If Nilgala has a required rate of return of 17%, what is the value of the stock? So this is the same type of a question where what we have already worked out. So you start working it out. The Nilgala mining company has been experiencing rapid growth during the last few years. Analyst expects 30% growth rate in dividends to continue for the next 4 years. Now here n is equal to 4. That is understood. After the above normal growth period ends, dividends should grow at a more normal rate of 6% thereafter. Nilgala has a current dividend of 260 per share. If Nilgala has a required rate of return of 17%, what is the value of the stock? Now, since you have a dividend growth of 30% at the beginning, and only the required rate of return is only 17%, you are not in a position to use one stage model to work it out, to work this sum out. Compulsorily, you need to go for the 2-stage model. And first of all, you calculate the first 4-year cash flows and its present values, or the present value of first 4-year cash flows. Just calculate and let me see the answer. Now, in the first 4 years, what happens? The growth rate is 30%. And the dividend, current dividend is 260. Then therefore, you are in a position to get the present value of those 4-year cash flows. And required rate of return is 17%. So I just ask you to do this calculation and come up with your answer. Now I am just asking you to do the only first 4 years. Only first 4 years. You try to get it. All of you should have a calculator with you. Yes, just look at it and see. Now the first term would be 260 into 1 plus 0.3, that is 1.3 divided by 1.17. That is the first term. The second term is 260 into 1.3 to the power 2 divided by 1.17 to the power 2. That is the second term. The third term would be 2.6 into 1.3 to the power 3 divided by 1.17 to the power 3. The fourth term is 260 into 1.3 to the power 4 divided by 1.17 to the power 4. Now I just ask you to do that calculation and see the answer. If anyone come up with that answer, you just put it on the chat. Now Laknath, Sanjeeva, Chamali, all can. Yes, good. Chaitani has done it. Yes, good. 13.629. Yes. Yeah, good. Sanjeev, good. Yes, okay. Now, but this is not the answer. Now, there's another part to be added. Now, that addition is now at the end of the fourth year, the dividend growth rate will change. It would change. It would change to 6%. Now, what will happen then? Now, we assume that the stock would be sold at that point. So if it is sold at that point, we have to use the one-stage model. Now after using the one-stage model, we can apply the formula. Now that formula is D0 into 1 plus G divided by K minus G. But here D0 would become D4, not D0, because at the end of the fourth period, it happens no. So then it is D4. So when you say D4, what is the value? 2.60 into 1.3 to the power 4. That would be D4, that is 743 or something. And that has to be multiplied with 1.06 and divided by G minus K. Sorry, K minus G. K minus G, that is 17 minus 6, that is 11. That is 0.11. And it has to be present valued. And that is, you have to divide it by 1.17 to the power 4. Then you get that value also. Right, we will see that also. Yes, Chaitany's answer is correct. Now, but it is not the final answer. Now, Chaitany's answer is the present value of the sales proceeds of that share. 38.18. Yes. Now, what is the share price? 38.18 plus 13.62. Yes, Chaitany's answer is correct. Final answer is that. Correct. Very good. Very good. I think now you have got it to a great extent. Any questions you come across when you work it out? Inusha, you also can calculate the other part and then get the final answer. Right. Right. Now, if you have any confusion or any clarification, you can let me know and we can sort it out. It is natural to have some confusions or unclearness or whatever. That is a natural thing, but if it is not, it is not natural. So you would ask anything. Dinusha also has done it correctly. Deshan, yes. But make sure now when you answer the question, you need to put it to 2 decimals, because you are talking about the price now. So therefore, you need to put it in 2 decimals. Murthy, correct answer, correct. And if you go to the certain companies, and by looking at the stock market daily, you can gather several types of things from the stock market basically the monthly one. And the dividend information also given in that. So you can see how the dividends being paid for certain companies and see whether this type of things are possible in real life. The 30% growth of dividends or whatever, whether it is possible. But you will see that the startup companies, they normally do that in order to attract their shareholders. That is the nature of startups. Right. Rangika wanted me to do the second part also on the board. No, it's like this. Right. I will appreciate your question. Wait. Now, this is the this one is the sum given in the example, but now what we have done, I will do the second part only here. Right now, as per the this sum, this is the sum question number 3, Nilgala Mining Company, and its earlier growth was 30%, and for 4 years it went like that, but afterwards the growth became 6%. So at the end of the fourth year, we assume that the stock would be sold. So it would be sold at the price at that time. So we do the calculation to get the price at that time. So I will just put, so since the growth rate has become 6% and it is less than the required rate of return, you can apply the one-stage dividend discount model to calculate the price at that time. So we will do that. So this is the one-stage model. So price is equal to, that is what you call P4, is equal to D4 into 1 plus G, that is G2, divided by K minus G2. This is the price at that time. So we will apply, or we will substitute the values for this. So D4 will be 2.6, that is the D0, 2.6 into 1.3 to the power 4. Then again we have to multiply with 1 plus G2. Now G2 is 6%, that is 0.06. Then it would be 1.06 divided by K minus G2. K is 17%, so that is 0.17 minus G2 is 0.06. Now this is the price at the end of the fourth period, or fourth year. We assume that it would be sold at this price. But we need to get, now we assume this is the sales proceeds. But that sales proceeds you receive at the end of the fourth year. Therefore, we have to get the present value. We can say PV of P4 is equal to 2.6 into 1.3 to the power 4, 1.06 divided by now this 0.17 minus 0.06 is 0.11 into 1.17 to the power 4. Now if you work it out, you will get the answer. Two point six into 1.3 to the power 4 into 1.06 divided by 0.11 divided by 1.17 to the power 4. Yes, you would get the answer 38.18, 38.187. So if you put it into the two decimals, that would be 38.19, 38.19. And earlier one, the cash flows, the total of present value of cash flows for the 4 years, you got the amounts you got. $13.62. Then your value here is 13.62 plus 38.19. That would be 51.81. 51.81 is the answer. I think that someone has asked me to, yeah, Rangika's problem is okay now. Rangika, is that okay? Right.
Okay, sir.
Right. I think now you got it clear now. If you had any issue, let me know. Then we can discuss. Right. Now, if you don't have any issues, I will go to the next section. Right. Now we have already completed the discussion of one-stage dividend discount model and the two-stage model. And you all know the conditions on which we apply the one-stage model and conditions on which we apply the two-stage model. In order to apply the one-stage model, you need to have a situation where the required rate of return has to be higher than the growth rate of dividends. But if it is not so, what will happen is you are not in a position to calculate the stock price by using the one-stage dividend discount model. But of course, you have to apply the two-stage model to get the dividends, get the stock price calculated. So there's a particular methodology to do that, and we already discussed that methodology. Now we will go to another subject area where we deal with the earnings aspect, not the dividend aspect, the earnings aspect. And we call it valuation of stocks under earnings approach. Some investors like to use an earnings approach to common stock valuation. The one-stage model can be stated in terms of earnings. Now, one-stage model also can be applied in another perspective, in an earnings perspective. Now, we will see how we can apply that. Now, by definition, you just put, now D is the dividends, E is the earnings, and B is the payout. Earnings, sorry, B is the earnings retention rate. Now, earnings retention means 1 minus retention is the payout. Now, payout means out of earnings, how much or what percentage you pay as dividends. That is what you mean by payout. Payout is 1 minus B. B is the retention. Retention is the amount you keep in the business. For example, say you have earnings of 100 and you retain 60%. You retain 60%. Therefore, your dividend rate is, payout rate is 40%. So 1 minus 60 is 40. So 100 minus 60 is 40. So that is how these payout ratios, retention ratios, and all connected. Now that is how the definition is given as D equals E into 1 minus B. E is earnings, D is dividends. Now when you say E, it is earnings per share. I am 1 minus B. B is the retention rate. Now we will see how we can apply that into our models. Now see, when you say our dividend discount model in a very simple form, that is P0 is equal to D1 divided by K minus D. So that is our one stage model. In the place of D1, we can put E1 into 1 minus B. So that's actually, we have already gone through that, and that particular relationship is true. Now we call the D1. D is the payout of earnings. Dividends are created through earnings. Part of earnings you put as dividends. I will give another example. Say you have a earnings of 100 and your retention ratio is 80%. Then your dividend payout ratio is 20%. So 20% of 100 would be 20. So that is the dividend is 20 in that case. So if you put it to a D1, D1 will be equal to D1 is equal to E1 into 1 minus B. E1 into 1 minus B. That's what we put it here. Put here. Now you just look at it. Yeah. And this growth rate, if you take in terms of growth rate, if you have a dividend growth, if you have an earnings growth rate of some nature, now that really will become the dividend growth rate also. I think that you need to think and see. Earnings growth rate would be equal to the dividend growth rate. If you don't change your retention rate. We'll see whether it is correct. Now say, now I just started with the earnings of 100, no? And I put the retention ratio as 80%. If that is the case, say earnings grown by say 50%. Earnings grown by 50%. So then it would be 150 next time. Now when you have 150 next time, what is the dividend amount? Dividend amount would be 20% of that. 20% of 150. That is 1/5 of that. That is 30. Dividend should be 30. But what was the earlier dividend? 20. Right? Earlier dividend was 20. So now what is the growth of dividend? 24 from 20 to 30. So that is 10 growth, and growth out of 20. So that is also 50%. So now you will see earnings growth should be equal to the dividend growth also. So that is the connection between earnings and the dividends. Now you will see that it is also true that E1 is equal to E0 1 plus D. E0 is the current earnings per share, and D0 is equal to E0 into 1 minus B. And D0 divided by E0 is equal to 1 minus B. Okay, the one stage equation can be written as follows. P0 is equal to E0 1 plus G into 1 minus B divided by K minus G. Now, what has happened here? Now, in the place of D1, we need to put D0 into 1 plus G, and D0 is equal to E0 into 1 minus B. So that is how the things been replaced here. And P0 can be taken as E0 into 1 plus G into 1 minus B divided by K minus G. And again, E0, what we did was we just put E0 down, and we have rearranged the things that way. And this is what you call the PE ratio. Now, 1 minus B has been replaced as D0 divided by E0. Now, there's a thing called PE ratio of a stock. PE is the stock prices ratio to the earnings. That is what you call PE ratio. That's a very important type of a ratio we are talking about in terms of stock investments. Now, I think I can just explain these things on the board also. How we can convert our applications onto an earnings basis rather than dividend basis. Because in terms of dividends, we already did all these things, but we can do it on the basis of earnings also. Now I will show it on the board. We call it earnings perspective of one stage model. Now, before going into that, we need to define these things. Now, we say E0 is the current earnings. B is the retention rate. D0 is the current dividends. Now, with that, we can establish this relationship. D0 is equal to E0 into 1 minus B. And there's a very important aspect here you need to look at. When you talk in terms of dividend growth, always the earnings growth is equal to dividend growth. Why do we say that? If you have a particular retention rate, then when the earnings grow at a certain rate, the same growth rate applies to the dividends. You can show that through this equation. That's what through an example I told you. Now I got an example of earnings of 100 and the retention is 80%. So if that is the case, dividend would be 20 because 80 retained. 20 would be the dividend. When the earnings is 100, 20 is the dividend as per our retention policy. Now say the earnings have grown up to 150. So that's what is the growth? The growth is 50%. Now we will see whether the dividends also go at the same rate. Now just look at it. 150 is the earnings. What is the retention rate? 80%. If you retain 80%, what is 80% of 150? Should be 80% of 150 would be 120. So what is the retained amount? Sorry, what is the dividend amount? 150 minus 120, that is 30. Dividend amount is 30. Now what was the earlier dividend? 20. 20 has become 30. What is the growth? 10 is the growth and 10 out of 20 is 50. So you see, the earnings growth is equal to the dividend. Or dividend, because the earnings growth is the first thing which we experience. So if you experience an earnings growth of 50%, same growth will happen to the dividends. Right. So then the G, that is the growth rate of dividends, can be applied similarly to the earnings also. Right, okay. Now we will just look at the one-stage model. Right, P0, that is the price, is equal to T01 plus G divided by K minus D. Now we can replace D0 with this one. So we can say E0 1 minus B into 1 plus G divided by K minus D. Now we can get a good expression for the PE ratio. So E0 is here. You can rearrange this equation to read as P0 divided by E0 is equal to 1 minus B into 1 plus G divided by K minus. So this is the PE ratio. PE ratio. And if you want to replace 1 minus B, there's another way of doing it. You can put it as D0 divided by E0. That is what explained in the lesson. Right. I think that is understood. And you can see why we have taken this earnings aspect into consideration. Right, now we will go to the example. The Venus Corporation currently has earnings that are $4 per share. Now they go in the terms of earnings. In recent years, earnings have been growing at a rate of 7.5%. And this rate is expected to continue in the future. If the Venus Corporation has a retention rate of 40% and a required rate of return of 14%, what is its current value? Now, a retention ratio has already been given. So how are we going to deal with that? Now, of course, in this particular question or example, now the price has to be calculated. So first of all, what we have done was we just put the available data clearly. So earnings, current earnings is dollars per share. So E0 is equal to 4. Then what is G? 7.5%. In decimal form, it is 0.075. And yeah, retention ratio is also given. So then we are in a position to see the dividends, amount of dividends also. So that's up to us to do whatever we want. Now just look at the solution. Then P0 is equal to E1 into 1 minus B divided by K minus G. Now all the things being applied there. So data being applied. So with the application of data, you will arrive at the price at as 39.69. The value of stock is 39.69. So I think there's no big issue here. So you have to derive in earning terms the equation, the one-stage model. Now normally the one-stage model starts with D0 is equal to D1 divided by K minus G. D1 also can be replaced by D0 into 1 plus G. So D0 can be taken as E1 into 1 minus B. That is what we did here. Okay. Okay, now can you just work out the sum number 4? Question number 4. Can you now try to work it out? The Miller Corporation has current earnings per share of $6. Assume a dividend payout ratio of 55%. Payout ratio 55. So earnings grow at a rate of 8.5 per year. If Miller's required rate of return is 15%, what is its current value? So you can do it either way, because if you want to do it on a dividend basis, that also can be done, because you have been given a payout ratio. Because if you know the earnings per share, then you can calculate the dividend amount also, since the payout ratio is given. Right? Can you just try it and get the answer? Plus D. Minus K minus D. Right, I think you all can try to work it out, the current value of the stock to be calculated. You calculate the current value of the stock in the question number 4, the supplementary problems. Problem number 4. Now all of you can attempt the question. Rather than going to a formula, I think you can go into the first principles, then that would be easy for you. You don't need to have a burden of memorizing the things. Now, when you start with the question, dividend payout ratio is 55%, and earnings per share are given, that is 6, and it can be multiplied with 55%. So 6 into 0.55, and you will get a amount that is the dividend amount. Current dividend would be that. And if you say earnings grow at 8.5% per year, dividends also grow at the same rate, 8.5. If Miller's required rate of return is 15%, what is the current value? So you can just do it without much issue. Yes. Get an answer for that. Wyoming, just do it again. Here you got the dividend payout rate, not the retention ratio, right? Payout ratio is given. So therefore you need to multiply it with 0.55. Yeah. Now I think some people have made some mistakes. That is natural. Now look at the question. they have given not the retention ratio, they have given the payout ratio. What do you mean by payout ratio? So you need to calculate the dividends by looking at the earnings. Earnings 6 you have. Then in order to get the dividends, you have to multiply with the payout ratio. 6 into 55% is 0.55. 6 into 0.55 comes as 3.3. 3.3. And that is the amount of dividends. So growth rate is 8.5%. So therefore, 3.3 has to be multiplied with 1.0875. That comes to 3.588 and it should be divided by K minus G. K is 15. G is 8.5. So then you get 6.5. So 0.065. And the answer is yes, 55.21. Yes, Wyoming. 51.21, 55.21 would be the answer. Why you got 0.8? Udeshan also got 0.8, no? X into 0.55 into 1 plus G. 1.085 divided by 0.6. 55.08 is correct. 0.8 is correct. Chaitany's answer is correct. Wyoming, you just look at it again. 8.5 is the growth, earnings growth rate. Dividend growth rate is the same. Okay, Nisansala wanted me to do it on the board. Yes. Right, we will put on the board what they have given in the problem. Earnings per share is 6. So you can say E. 0 is 6. Then dividend payout is 55%. So that is 1 minus B. 1 minus B is equal to 55%. Earnings growth is 8.5. So D is equal to 8.5%. K is equal to 50. So we need to get the current value. So current value can be taken from this. So we start with the one-stage model where P0 is equal to D0 1 plus G divided by K minus D. This is the formula. But here we got some earnings aspect. So therefore, D0 is equal to E0 into 1 minus B. So that is, you can say, now we can replace D0 with E0 into 1 minus B. Minus G. Now we will put the figures for this. E0 is 6. 1 minus B is 55%, 0.55. 1 plus G is 1 plus 8.5, that is 1.085. That comes to the numerator. In the denominator, you get A minus G. What is K? 15%. G is 8.5%. 15 minus 8.5 would be 6.5. 6.5%. That is 0.065. If you do the calculations, you will get that answer. Six into 0.55 into 1.085. Now that comes to 3.5805. That is divided by 0.065. That is 55.08. That is the answer. 55.08 would be the answer. Okay. Any questions on that? Now, Lisansala, are you okay now? Right. Now, shall we go to the next question? That is the Mahadana Corporation Trading Company. Not Mahajana, Mahadana. Trading company is expecting earnings per share next year to be next year, right? It is $5. If earnings have been growing at a rate of 8% per year in the past 10, this growth is expected to continue in the future. Determine the current required rate of return for this company stock. Assume a dividend payout of 60% and a current price of 65. Now they have given the earnings per share next year, that is E1. They have given E1. So then you can put it as D1. So you have to, now when you have E1, you will be in a position to calculate D1. Right? So that is the next year's one. So how can we get about? They have given here E1, not E0, because the next year's earnings per share. Now, when you have next year's earnings per share, you would get dividends also by looking at it. Now, you just look at the other data available. Dividend payout of 60%. Now, when you say dividend payout is 60%, so you can calculate the amount of dividends next year by multiplying 5 with 0.6. That is 3, is it? Dividend is $3. $3 is the dividend amount in the next year, and it is to be divided by G minus K minus G. So just a simple thing. But K has to be found. We have to find out K, required rate of return. Price is given. Current price is given. Yes, We try? Shall we try? You can try. Dividend can be calculated by looking at the payout ratio, that is 60%. Dividend is earnings is 5, is 3. Dividend is 3 divided by K minus G. G is 8%. Yes. Try to get the answer for this question number 5. Just try to get the question number 5, answer of the question number 5. It is little challenging because you can't get the values straightforwardly, and you have to work it. You have to solve on an equation. Solve an equation. That is the only issue there, but it is not that difficult. .9. 8.9. 8. Nalinda's answer is correct. Nalinda's answer is correct. 12.6. Yeah, Murthy, you are correct. Isuru, can you try it again and see? Yes, a small thing. You are close to the answer, but something wrong, I think. Murthy has done. Yes, it's correct. Murthy's answer is correct. 12.62. Yes. Udeshan, you try it and see something wrong, I think. Nalinda, correct. Payomi, correct. Okay. It's a little challenging one because you have to solve an equation. After solving the equation, you can get into the answer. Now, first of all, what you need to do is you need to convert your earnings to a dividend type of a thing. Because since you have earnings and the dividend payout, what you have to do is you just get the dividend and multiply it with dividend payout ratio. And you will arrive at the dividends. So 5 into 60%, that is 3. Dividend should be 3. Then if you go into the formula, now the formula has to be given. So you can say P0 is equal to D1 divided by K minus D. Why do we get D1 here? Because the given earnings was for first year, next year. So therefore it is E1. So therefore we got D1 by multiplying with the payout ratio. So then D1 divided by K minus D is equal to 65. That is the equation. So what is D1? It is 3. K minus D is, K we don't know, K we have to calculate, and minus 0.08. G is 8%. So it is 0.08 in decimal form. Then you get an equation. 65 is equal to 3 divided by K minus 0.08. If you do the interchange of this equation, you will get K minus 0.088 is equal to 3 divided by 65. So then K is equal to 3 divided by 65 plus 0.08. That is how the answer comes. And when you calculate 3 divided by 65, it comes to 0.046 plus 8, 0.08, sorry. So that comes to 12.6. Yes, Dinusha, yes, yes. As usual, I will do that on the board. I think most of you find it difficult to just get it through the lesson. So I appreciate your problem, because most of the people get a good idea on when we explain it on the board, right? Okay. You make sure at the beginning you write down the available things at the beginning. Now this is, we talk about the Mahadan Trading Company expecting earnings per share next year to be $5. So that is E1. E1 is equal to 5. Then what else did they have given? If earnings have been growing at a rate of 8% per year, so that is G is equal to 8%. Determine the current required rate of return for this company stock. So that is K. So when K is not given, you will need to put a question mark. So that is what we have to find. Assume a dividend payout of 60% and a current price of 65. So the P0 is 65. Payout is 60%. So we can say 1 minus B is 60%. Right. Now we can start the calculation by putting the equation first. So we have to apply the one stage dividend discount model, or whatever it is. Even earnings also can be taken as it is. So you can put P0 is equal D1 divided by K minus. But here D1 is not given, but E1 given. So we can put D1. In place of D1, you can write E1 into 1 minus B divided by K minus D. Now this is the important thing, right? So replace D1 with this particular statement, E1 into 1 minus D. So what is E1? It is 5. 1 minus B is 60.6 divided by K minus D. We don't know what is K minus D. D is 0.08. And this side P0, then P0 is given as 65. Now this is the equation. So we can cross multiply this, or you can interchange these two things. So you will rearrange this into this. K minus 0.08 is equal to 5.6, 5 into 0.6 divided by 65. So what is 5 into 0.6? That comes to 3. Okay. Now when you do this calculation on the calculator, you get 0.046. A minus 0.08 is equal to 0.046. So that means K is equal to 0.046 plus 0.08, and that comes to 0.126. As a percentage, it is 12.6. This is the required rate of return. I think you get a clear understanding of it. Dinusha, right?
Yes, sir. Yes, thank you, sir.
Right. I think we have done the questions. What I feel is now you all should do these things on your own. Then only you can have a very straightforward and very sharp knowledge on these things. What I feel is rather than doing it mechanically, you need to do these things with an understanding. Otherwise, you would not be in a position to apply these things in your day-to-day work environments. Because you need to see the this is a support for your decision-making activities. Some of the people might not need these things, but in future, invariably they also will need these things. Yeah, I will give you. Only thing is now I have given only 6 questions at the end of the lesson. It may not be enough, I think. And I will show you something else also now, because some other presentation is there. Right. Now, I have just prepared presentation on this, on equity valuation process. Now, these are the valuation approaches. Discounted cash flow valuation, intrinsic value we call it. That is what we have done now. Then there's another valuation called relative valuation. Estimates the value of an asset by looking at the pricing of comparable assets relative to common variable like earnings, cash flows, book value or sales. Now, this is another way of doing a valuation. Now, in this particular presentation, I tried to put you into a particular environment where you can get some comparative type of a knowledge. And there's another thing called contingent claim valuation, option pricing models to measure the value of assets. So that is what you mean by contingent claim valuation. Now here the models being given here as in a shortened form. DCF is discounted cash flow model, relative valuation model, economic profit model, dividend models. Now dividend models, you have dividend discount model, constant growth dividend discount model. These are the things. And there's another way of doing valuation through the equity and balance sheet valuations and PE ratios. Now, this is the discounted cash flow method. This is equity valuation. Now, the dividend growth model, which we have already discussed, comes into this nature. Since someone has asked about questions of the same type to be practiced, so I think that's a good idea, because you can have some questions and just do the questions on your own. Right. I will put a particular sum on the board and you can work it out. Right, I just put a question on the board. Okay. Now, just look at it. The Minerva Corporation has current earnings of $4 per share, $4 per share, and the earnings growth rate of 7.5%. That is expected to continue in the future. Retention rate is 40%, and the required rate of return is 14%. What is the price of the stock in 4 years? That is the question asked. What is the price of the stock in 4 years? You gather what I have said on the board and you try to work it out. It's not a difficult one, but and I want to just give you certain type of indication where we have already done the one stage model. There you get P0 is equal to D1 divided by K minus D. If I want to get the price of P1, that is the price at year 1, how should it be? P1 is equal to what? D2 divided by K minus D. D2 is the second year dividend. If you want to get the 4th year price calculated, then it should be what? P4 is equal to D5 divided by K minus D. I think that you got my point. When the dividend discount model is mentioned or it is written, we put it this way. P0 is equal to D1 divided by K minus D. So always the D comes 1 ahead of P. P0 is the current price. P1 is the price at the year end, year 1. P2 is price at year 2. Now in this particular problem, you are required to calculate the 4th year price, 4th year. That is P4. P4 should be, what is the, as per the dividend discount model, that is D5 divided by K minus D. D5 divided by K minus D. You got my point? Yes. Can anyone try this for the time being? Now there's very little time for us to work out. But anyway, I like to have your views here. If someone can calculate the figure. Yes. Yes, anyone tried to do that? I will give you a set of questions later with some other lesson units, and I will give you some questions of this nature. Right, anyone has tried this? Because here the question and you are required to get the price at year 4. So that is, in other words, in symbolic form, it is P4. P4. P4 is equal to D5 divided by K minus DQ. If you keep that in mind, so you will be in a position to get the answer without much issue. Okay. So I think today we may not be able to go further. I think at this point we need to wind up. Anyway, do you have any confusions or any clarifications or anything you need to know? Yes. Yes, let me know something. I mean, if you have any issues or you have any problems or whatever. It is very good that you just mentioned that work it out on the board or something like that. No, those things are okay. I really appreciate that type of things, because if you do not understand the things, I mean, this worth is not worth of my attempts, and all sort of things are in no value. So therefore, you need to argue with me. You need to ask so many things. You have to query me, or everything you need to do. Then only you can learn in a better way. Yes, anything else you need to clarify? Right. So with that, I wind up today's session, and we will meet in the next week. And in the meantime, you need to go through what we have done for the up to now, and you should get a good understanding about these things, and we will have more challenging things in time to come. I just want you to do on your own certain type of assignments or whatever, and some practical type of things. I will just give you instructions as and when necessary. But for the time being, what you need to do is you need to go through the things which we have already done and get a good understanding about it. That if you feel anything is not very much clear, you need to ask me, and you need to clarify those things at any time. Right. With that, I wind up the session. Thank you very much for your live participation, and I will ask all of you to keep it up in time to come. Thank you very much.